Markets, we know, have been hard to gauge to start the new year, and recent econ data has made it even harder to forecast what's to come. So as investors look to reshuffle their portfolios in these volatile times, where should they be focused? We have just the man to tell us. John Maier, Global X Chief Investment Officer, joins us now. John, it is great to see you. Thank you for joining us.
Thank you for having me.
Maybe we'll start, John. Listen, today we got some big bank earnings, Goldman, Morgan Stanley. So officially we're in sort of peak earnings time now. Just broadly, John, when you look at this earnings season, are you expecting to hear good things? I mean, is this going to be a positive catalyst for the market?
Well, banks typically come out first, and so far the numbers have been fairly good. This is very early in the season, but I do believe that we're coming out of the earnings recession, and you are going to see some growth, probably 3 or 4% overall in the S&P 500, but you're going to see some revisions down. It's more like 6 or 7% expected. I think that will help the market, particularly when you hear some of these executives talking about what's going on in the space, whether they're talking about AI, capex, things that will help them improve their overall efficiency. And I think that's what the market is seeing. Every time you see kind of a mass layoff, not a positive, but you do see companies tend to do well. So the improvement in efficiency, I think, is really important. And we believe we are at peak interest rates. And I think that's important as well, because as interest rates decline, the market breadth will widen out. As Josh was talking about, I do believe small caps will continue to be a beneficiary, mid and small caps.
Well, going into efficiency, Meta's year of efficiency, really rewarding that name in 2023. When you look at the broader big tech rally that we've seen and kind of the narrowness of that rally, what will be the catalyst for more growth this earnings cycle for those 7 names?
Well, I think those 7 names are difficult because the market certainly was getting ahead of itself. Now, in November and December, we saw that market breadth widening out, particularly when the market got a hold of that potentially that the Fed was at peak interest rates and potentially cutting rates. So I think that was very important to the market. But there's still a lot of enthusiasm for most, not all of the 7, but most of those 7. NVIDIA chips, where else are you going to get them? AMD is up a lot today on some news and earnings. But I think some of those companies are in such good positions. AI is all about data. Those companies have tremendous access to data.
And John, I want to get your check on the Fed. We continue to hear from our policymakers there. Market's expectation is Fed's going to cut early and they're going to cut often. Is that what you see?
Well, it's coming down a little bit. So the market is expecting 4 cuts this year. The first one in March. Last week it was 80%. Right. This week it's 65%. Let's see what it is next week. The market's telling us today that potentially inflation coming back with some oil disruption potentially in the Red Sea. That's an issue. Some of the data, the economic data is murky. The CPI numbers ticked up a little bit, although the PPI numbers are pretty good. So there's uncertainty, and the labor market is stronger than expected. So there is some uncertainty in the macroeconomic data, and I think that's what the market is reacting to right now, and you're seeing rates go up a little bit.
And the market action today, in particular after Waller's comments, really throwing some red on my screen when it comes to the trade today. What is your advice for investors on Fed speak in particular as we kind of navigate these rate cuts to come this year? What should investors be thinking about on days when they hear Fed speak, when they hear dovish or hawkish commentary?
For the everyday investor, I think they should kind of block out some of the day-to-day information. If you look at the environment that we're in and what factors will do well in the market, we think quality and low volatility will do well when there's an economic slowdown. We're not going to have GDP numbers like we did in the fourth quarter. Inevitably, we're going to slow down. But I don't believe we're going into a recession. I think the Fed has been able to navigate a slower, a softer landing, which is possible.
You didn't want to say it almost. I could see it in your eyes that you didn't want to say soft landing.
It's been overused, right? So, but I think it's possible.
Yeah. And John, you mentioned the word quality there. You're looking for quality names. How do you define quality? What do you screen for that?
Right.
Companies that have consistent earnings, strong cash flows, that are less reliant on the economic cycles. So I think those are the factors that we look at when we're looking at quality.
Any big risks that you're concerned about for the year to come? You mentioned the Red Sea. Is that at the top of your list?
There are geopolitical risks abound, right? So that's a concern. If the issues in the Middle East broaden out, that could be certainly an issue. There's an election coming up that certainly could move markets one way or another, but I think we're a ways away from that. I think you need to be more 3 or 4 months away from the actual election.
Sure.
So geopolitical risks are my concern right now.
Yeah, there's plenty of geopolitical tension to go around, so
There
that
is.
does make sense. John, thank you so much for
Thank
joining
you.
us. Thanks for coming on set. We
Appreciate it.
really appreciate that.